Dollar cost averaging, the Buffett principle for regular investors. While Buffett waits years for the perfect moment to deploy his billions, your monthly paycheck might actually be your greatest investing superpower. That regular income stream gives you access to a mathematical advantage that even Warren Buffett can't fully utilize. I'm talking about dollar cost averaging, the surprisingly simple strategy that automatically turns market drops into wealth-building opportunities without requiring perfect timing or billions in the bank. Most of us don't have massive cash reserves sitting around waiting for the next market crash. We're working jobs, earning regular paychecks, and trying to build wealth month by month. That's exactly where dollar cost averaging thrives. Instead of timing the perfect moment to invest a large sum, you simply commit to investing a fixed amount at regular intervals, weekly, monthly, or quarterly. The genius of this approach automatically implements Buffett's "be greedy when others are fearful" principle without requiring special decisions during market downturns. When stock prices drop, your fixed investment amount naturally buys more shares, like a shopper who automatically gets more groceries when prices are on sale. When prices rise, you buy fewer shares. This systematic approach removes emotion from the equation, precisely what Buffett has mastered through years of experience. Let me show you how powerful this can be with real numbers. Imagine you invest $500 every month into an index fund. In month 1, the share price is $50, so you buy 10 shares. Then the market takes a dive, and in month 2, the price drops to $40 per share. Now your same $500 buys 12.5 shares. You're scooping up 25% more ownership for the same money. If the market recovers in month 3 and the price jumps to $60, your $500 gets you 8.33 shares. After 3 months, you've invested $1,500 total and acquired 30.83 shares at an average cost of $48.66 per share. That's less than the current market price of $60. Without trying to time the market, you've positioned yourself for profits simply by staying consistent through the volatility. This mathematical advantage means you naturally buy more shares when prices are low and fewer when they're high. The approach works most effectively when markets are volatile, exactly when emotional investors make their biggest mistakes. Picture this. When the market drops 30%, your fixed investment suddenly buys 43% more shares each month without changing your strategy. You're automatically being greedy while others panic. This is why Buffett himself recommends index fund dollar cost averaging for most individual investors. He's famously said, "The best thing to do is invest in an index fund over a long period of time." He understands that most people don't have his decades of experience or billions in cash, but they do have regular income that can be systematically invested. Studies consistently show this approach outperforms attempts at market timing over the long run. The data is clear. Investors who jump in and out of the market based on predictions typically miss the market's best days, which often occur during volatile periods. An investor who missed just the 10 best days in a 20-year period would have $3 million less in earnings on a $1 million investment compared to someone who stayed fully invested. Dollar cost averaging helps avoid this costly mistake. Now, want to supercharge these results with minimal extra effort? Consider implementing enhanced dollar cost averaging. Like adding a turbocharger to an already reliable engine, this simple twist can dramatically improve performance. During significant market drops, 20% or more, increase your regular contribution by 10 to 25%. This allows you to capitalize even more on discounted prices while maintaining the disciplined approach that makes the strategy so effective. This enhanced approach works across various investment accounts. Your 401k contributions, IRA investments, and brokerage account purchases can all follow this principle. In fact, if you're already making regular contributions to a 401k, you're practicing dollar cost averaging. You're building a retirement nest egg through the power of buying more shares when prices fall. What makes this strategy particularly valuable is its effectiveness for volatile investments. While Buffett focuses on stable businesses with strong fundamentals, regular investors using dollar cost averaging can apply this approach to more volatile sectors like emerging markets or technology stocks. The greater the price swings, the more this strategy can lower your average cost basis. Remember that dollar cost averaging isn't a magic bullet. It doesn't guarantee profits in a market that continues declining without recovering. The strategy works on the fundamental assumption that markets eventually rebound, the same assumption underlying Buffett's approach. The difference is you don't need to predict exactly when that rebound will happen. Some critics argue that lump sum investing outperforms dollar cost averaging in rising markets, which is mathematically true. If markets only rose, putting all your money in at once would be optimal. But markets fluctuate, sometimes dramatically. Dollar cost averaging provides both mathematical and psychological advantages during these inevitable periods of volatility. The psychological benefit is substantial. By committing to regular investments regardless of market conditions, you develop the habit of consistent investing. This removes emotional barriers that prevent people from investing during downturns, precisely when the best opportunities often exist. You're less likely to panic sell because your strategy already accounts for market fluctuations. Another advantage is accessibility. Anyone with regular income can implement this strategy, regardless of investment knowledge or experience. You don't need special access to opportunities, billions in capital, or decades of market experience like Buffett. You just need consistency and discipline, qualities within everyone's reach.